reside on that they're issuing these bonds. So although this has been studied to some aspect by the people from the Capital Allocation Project on the perspective of mutual funds, this has not been studied very systematically across the different types of institutional investors, which is exactly what we're going to show you. And we're going to show this with this very unique data set, the SHS, which is the universal securities held by Euro area investors, issued by both domestic and foreign firms, matches with prices in a number of bond characteristics. We're going to focus on the portfolio holdings of non-financial corporate bonds issued in US dollars and euros, so we're not going to think about other currencies, but they, again, are just a small percentage of this. We're just going to, US and dollar denominated bonds are about 95% of the total holdings in the euro area of non-financial corporate bonds. And our strategy, because our data is security level, allows us to estimate the euro-dollar return differential that we see in these bonds. And this is going to be a special period we're going to be studying because we see the total amount of these bonds being shopped by the ECB asset purchase plan, and specifically the drained euro-denominated bonds. Let me give a quick summary of what we find. We find that in aggregate, we're going to start the first part of the day, we're going to report a number of portfolio holding statistics. We're going to do everything top down. So I'm going to start doing it by all investors and then start doing it over different types and classes of investors. And we see that from the top down, in aggregate overall, euro area investors, they have a home currency bias as about 70% of these bonds are held in euro denomination, but they don't seem to have such a strong home currency issuance of bias, home country of issuance bias, because about 50% of the portfolio is issued by a firm that is a resident of the euro area. But again, what we see is that there's two types of institutional investors that really stand out. This is what I'm going to call now mutual funds plus and pension funds and insurance companies. And these are they're going to hold that they're going to intermediate about 90% of the total non-financial corporate bonds held in the euro area. And these are going to be large, but they're going to be heterogeneous. So what happens, the preferences of mutual funds with respect to currency denomination and country of issuance is going to be very different than what we see for pension funds and insurance companies, which tells you that the results that the capital allocation people that uses mutual funds should not be generalized for the entire economy. What we see is that mutual funds plus have no currency or country bias. They are willing to hold euros and dollar denominated securities almost equally, and no country of issuance bias. On the other hand, insurance companies and pension funds are going to show a very strong home currency bias. They're going to hold about 92% of their portfolio of non-financial corporate bonds in euro-denominated securities, and have a stronger desire than relative to mutual funds for bonds issued by euro area firms. About 67% of their portfolio are issued by euro area firms. Actually, the importance of this result is that this heterogeneity matters. Specifically this large holder of bonds, the pension funds and insurance companies, from our perspective, they don't see the dollar or the euro-denominated bonds as completely substitutes. Right? So there's some segmentation here on the preferences. And what happens is, what this means is that in a moment that the asset purchase plan of the ECB starts taking out euro-denominated bonds from the market, this is going to have an impact on prices. And what we're going to see is that this impact is really significant to the point that the euro area, the euro-denominated bonds are going to be significantly cheaper, even when we account for expected or hedge for exchange rate movements, than the dollar-denominated bond. So if we think about here on UIP-CIP deviations, these are going to be significantly large for the period that we studied between 2012 and 2021, between 150 to 50 basis points of euro area bonds, euro-denominated bonds, having a lower required return. So it's like these insurance companies and pension funds, and even also the mutual funds, are taking a hit in their return for holding these euro-denominated bonds instead of dollar bonds. And we're going to try a little bit to think about portfolio, but I'm sure I'm not going to have a lot of time right now. But let me tell you exactly, we're going to start talking about the data style facts. We're going to tell you how exactly our methodology allows us to measure the dollar-euro return differential using security level data. And then we'll see how far we get. Okay, so we're going to have security holding statistics, but we use the sector data with statistics. This is valuing things on a trillion scale, so this is pretty significant. And we know that at the holder type of each security, you know which type of institutional investor that holds the security. We're going to have security level information, so we have the security identifier, which allows us to match the price and security characteristics. We're going to focus on non-financial corporate debt in euros and dollars. It's about 95%, so whenever we're going to be talking about return differentials, it's between the US dollar and the euro. This is the only currency pair that we're focusing on here, but it accounts for the majority of our data. So now, we see the data by investor type. We have 23 types of investor category, so we know exactly how much of each security each investor holds. We actually aggregate that investor type by 6 categories. The ones that I want you to focus on is insurance companies and pension funds, which I go by the acronym of ICGF. I will try to say it as much as I can because I hate acronyms because I get lost. And then the other one is going to be OFI, other financial institutions. This is just going to be the mutual funds plus the object that I was talking about before. So these are just going to be mostly this category. And then we also going to split them by this issuer groups to think about currency of issuer, country of issuance residency, and we split it between euro area issuers, so think about the firms because these are non-financial corporate bonds, US issuers, and rest of the world issuers. I'm going to present different cuts of the data based on these categories. So without further ado, let's see this beautiful data. So here in the top, this is going to be all the holdings of non-financial corporate bonds between 2014 and 2021. Again, this is trillions of euros, and we see the first, how I started in my top, the rise of capital flows has been heavily intermediated. We see that it starts with 1 trillion holdings of non-financial corporate bonds, and in the span of 7 to 8 years, it goes to 2 trillion of holdings of non-financial corporate bonds. And the second part we see here is that this is broken down by investor category. So the big investors is going to be the yellow, insurance companies and pension funds, and OFI mutual funds plus. These dominate about 90, they intermediate, they hold about 90% of the non-financial corporate bond. In the bottom of the graph is going to be in terms of shares, so that's 100 here in terms of volume. Now we can break this picture down across currency, again top down, and we see that the euro is the dominant currency in aggregate, right? About 70% of the non-financial corporate bonds is being held in euro denomination. Dollar is significant, again, is edged to 100 because we eliminated every other currency that is being held, and it's about 70-30 breakdown. Blue is euro, red is US. Now let's do by investor type, right? So we actually now focus on going to be the 2 types of investors that hold 90% in granular guys. And we see that mutual funds, they like dollars, they hold about 25% of their bonds in dollar denomination, so it doesn't seem like there's this strong flavor for euros. As we see when we look at insurance companies and pension funds, they hold about 93% in euros. Then we see, well, this is about the country of issuance, this is about the country of issuance bias. And again, we see here we're going to have all investors, 52% in blue is going to be euro area issuers. In red is going to be these investors holding US issuers, and a yellow rest of the world. What we observe is about 53% of the bonds are going to be being held in the euro area, are issued by euro area firms. The rest is by the province. So it doesn't seem that there's a strong home country of issuance bias. We can see that this actually is different across the different types of investors. At the top we have mutual funds, or OFI, then we have insurance companies and pension funds, and it goes down by the amount that they hold. And what we see is that while OFI, or mutual funds, they don't seem to have as strong preference for euro area firms. They hold only about 40% of their portfolio from those firms. Okay. And what we see is that although there is a preference for firms from the euro area, this love for euro issuers is not as much as the love that these investors have for euro denomination. Oh my God, I'm really loud now. Okay, so now let's do the breakdown of the outside euro area. So the majority of the euro area firms are going to be held. I can't, I'm too loud. Really? Okay. Okay. The majority of the euro area holdings of non-financial corporate bond of European issuers is going to be held in euros. However, for the US and rest of the world, this figure is not as clear. So here we have, in this side, holdings of euro-denominated bonds, holdings of US-denominated bonds. And what we see is the following. For US issuers, so these are US firms, it looks like mutual funds have a strong preference of holding them in US dollar denomination, but insurance companies and pension funds really have this preference for holding in euro denomination. So this is foreign currency for these firms. And this preference actually has been growing throughout our period. Now, the figure for the rest of the world is the same. So let me collect our thoughts. So we observe that OFI, or other financial institutions, or what we can think about as mutual funds, are these granular investors, so they're large, but they have very heterogeneous preferences with respect to the currency denomination and the issuer. While mutual funds like dollars and foreign firms, insurance companies and pension funds, they like euros, and they have a slight preference for euro area firms, although their love for euros is much stronger than the love for euro area firms. Does this have an impact on pricing? And this is the biggest question, whether this is going to be their mandates or any other preference. What we want to know is that our price is being impacted. And actually what we're going to do is the second part of the paper. We're going to estimate euro-dollar return differentials using our security level data. So you can think about this. If I had two time series, one for the euro, one for the dollar, my job would be very simple, right? I can just compare the two. We don't have that, right? We have security levels, so we need to have a strategy that purges for a bunch of security level characteristics. This is beneficial because we don't have selection driving our aggregate time series. Because if we had, only the good firms borrow in dollars and only the bad firms borrow in euros, what is going to be driving the difference would be, in aggregate, if we saw aggregate data, could be selection. The fact that we have security level data allows you to control for all those things. So we're going to have only euro area investors, so they're facing the same monetary policy. And throughout our period, what's shocking the supply of euro bonds is going to be the ECB asset purchase. We're also going to exploit portfolio weights, which is a very unique feature of our data, which allows us to calculate return differentials within an investor portfolio. So let me show you exactly our regression. We're going to run the following regression. Here's going to be the yield for bond I at time t. Is going to change across the specifications, whether we're just going to compare dollars to euro returns, but this is apples to oranges, or if we want to adjust for expected exchange rate depreciation, expected exchange rate movements, so thinking about UIP and UIP deviations, or if we want to hedge for exchange rate deviations, differentials, thinking about CIP deviations. And here you have this dummy here that captures whether this bond is in euros. This regression is going to be run every period, and what the dummy is capturing is the interest rate differential between a dollar-denominated bond and a euro-denominated bond. If this dummy is negative, it's capturing the fact that the euro return is lower than the dollar return. Okay, and then we're going to do subcuts of the sample. So we're going to do different types of investors or issuer types, just like we did in the data, which then we would sum alpha 1 and alpha 3 when we're showing these results. So now how do we calculate the return differential? Again, we're going to do three specifications. One, which we call raw, which just compares the dollar return to the euro return. The second one is that we're going to do the UIP. Think about the unhedged, but adjusted for expected exchange rate movements, where if the bond is in dollars, we're going to calculate the synthetic euro yield by adjusting using consensus forecast data. So then if we're doing unhedged or UIP deviation, we do this second adjustment if the bond is dollar denominated. If we're going to do CIP deviations, we're going to run this regression here that uses the cross-currency basis swaps to hedge for exchange rate movements, right? So our bonds have an average maturity of 6 years, so our forward rates are not very liquid. So we use the Wenxin Zhu, Adrian Bedejan, and Tapper's trick to use longer term adjustments. And then we're going to do everything weighted and unweighted using Stephanie's QJE, which is allow us to capture also rebalance within portfolio. So let's see. All I'm going to show you are figures, I think. Yes, I don't have any graphs in the 20-minute version. So here's going to be the first. We have the timeline here, 2014 to 2021, same timeline. And what we're plotting here is literally this dummy variable that captures the return differential between a dollar and an euro bond. And if this return differential is negative, it's telling you that the euro-denominated bond has a lower required return, or the investor's taking a hit in their portfolio to hold euros. And we see that this is, without accounting for expected depreciation, it's really significant. This is about 250 basis points. I'm going to start making sense of this U-shape in a bit. What you see in dashed is the weighted, so it's within portfolio weight. So not only is the returns different, but they are actually holding these returns in a weighted sense. Here you have UIP, and we see that it's also negative. CIP, and it's also going to be negative. This is going to be the same alpha for different specifications of the Y. We can do this across different types of issuers. So we have black, which is all. Red is going to be US. Blue is euro area. And then cyan is going to be rest of the world. And what we see is that for a lot of the sample, here you have one is unweighted, the other one is weighted. What we see is that for a lot of the periods, the euro one, especially when we go to the CIP, the euro area firms have a lower, even lower return. It's kind of, they lead this lower return, which again is going to link to the asset purchasing plan. Finally, we see that insurance companies and pension funds, which is the red, are the ones that are holding this lower return. So we do the same analysis, kind of thinking about within its sample. And we see that this is mostly coming from, it's the one that has the lowest return. It's below, this is red, insurance companies and pension funds. Black is mutual funds. The insurance companies and pension funds, especially on the weighted sense, they get these lower returns. So why? Finally, this is going to be the last thing that I'm going to show. I'm probably out of time, right, Stephanie? Okay. Oh, I have a minute and a half? Okay. So now, what is driving this? I'm going to start talking about the asset purchase plan in the next slide. But this already starts alluding to what's driving it. We see that actually for the longer maturity bonds, this effect is higher. So we split the sample between below 6 years and above 6 years. And what we see, so here's going to be unweighted and weighted, again, raw, UIP, CIP. Net below zero, euro lower. What we see is that the long maturity ones actually have an even lower return. So you can think about if we hold only longer maturity, euro-denominated debt is going to have a lower required return. These yields are being smashed down lower, right? So this is going to be a deviation of about 50 to 100 basis points in the CIP, which is massive, okay? So what is driving this? So we start already, I was trying to allude this to the period where there's this drain, this scarcity generated by the asset purchasing plan. And again, I feel like I'm preaching to the choir. So what we know is that there was this purchase plan that purchased a large amount of euro area denominated bonds. So here we have the entire plan. We see, every period it goes up. This is going to be flows. Then here's stocks. And what we see is that the more the ECB purchase of euro-denominated bonds, it kind of starts relating, and we have a regression that correlates these two, and we see this very tight relationship between the purchase of the euro-denominated bonds and the lower required rate of return. Why is this? Well, insurance companies and pension funds, they really want to hold euro-denominated bonds, right, especially of longer maturity. And they are not seeing dollar-denominated bonds as substitutes, as there's this drain, this scarcity of the local supply channel being generated by this asset purchase plan is lowering the yields. This is going to happen more, especially on the longer maturity, because they're going to be smashing down the returns of these longer maturity bonds that are more risk. So there's this duration channel happening as well in the interest rate differential. And we kind of, although these have been highlighted in other literatures, it has never been highlighted that this also impact the interest rate differential between the dollar and the euro-denominated bond. This is exactly where we enter. I apologize that I don't have time to go through the model, but we have something that kind of explains this in the model. But again, what do? We show that institutional investors in the euro area are granular. They intermediate a large share of this market, of the non-financial corporate market, but they're not all the same. We cannot buy what Matteo Maggiore is trying to sell when they're looking at Morningstar mutual funds to say that this generalizes to all markets. Actually, you have someone who holds about 30% of these markets and maybe a lot more in other markets that is not substituting between euros and dollars. They don't have a dollar preference inside the euro area. So what we see is that the euro is dominant and preferred by some institutional investors, and this heterogeneity matters for price. Euros are going to have a lower yield than the dollar, and this is going to generate the scarcity of the security. This is going to be driven by the scarcity from the asset purchase plan. During the period that we analyzed, 2012 and 2021, what we observe for euro area investor is this erosion of the dollar convenience yield and a rise of euro safety driven by these segmentations between institutional investors and the asset purchase plan. Thank you.
Thanks so much for inviting me. Thanks a lot for organizing this session. It's a pleasure to be here, and also a great opportunity to read this very interesting paper, which I have seen presented before, but because it's so rich and has so many new facts, right, it's actually very hard, I think, to digest it when you just see the presentation. It's really challenging. And so when reading the paper, what I try to do, I try to kind of see what is the main story, right? And I see my goal for today is just to concentrate on the maybe key new stylized facts and try to think what kind of model can rationalize them. So in terms of motivation, I guess there are many different ways to motivate the paper, right? So one of them is that, well, UIP plays a crucial role in our models. We know that it is very important for several policy questions. It is important to understand the exchange rate movements. It is important to understand the exorbitant privilege. There's a huge literature studying the implications of the UIP, but the question is where these deviations from the UIP come from, right? And at some point, many years ago, there were just no models of UIP deviations. Now we have plenty of them. And the question is which one of them is correct, right? Which one of them is relevant for policy analysis? Okay, and so one way to see this paper is trying to make some progress in answering this question by combining the standard asset prices, right, the interest rates and exchange rate with the portfolios. Okay, and so also maybe going beyond just one UIP, but also think about UIP for different assets with different maturities. So what is special, what is really the key contribution of the paper is that it brings a new data set, right, which includes the non-financial corporate debt held by investors in euro area. Okay, so it is very granular in terms of the securities. At the same time, it is aggregate at the level of the investor type, right? And here's my kind of comment zero. It's just a semantic question, right? So whether we should call this granular investors in the title or not, that's a bit of subjective, right? So it's aggregate holdings of, let's say, mutual funds, right? Sometimes people call, when they say granular, they mean that there's one particular investor which holds a lot of assets, right? So I think it just deserves a bit of discussion in the paper. Okay, so let me now summarize the key stylized facts about portfolios. So the first one, as Juliana already showed, is this shares of holdings by different types of investors. And the thing that comes very clearly from the speech is that there are two main types of investors which hold most of this debt, right? This mutual funds plus and this insurance corporations and pension funds. Okay? So then there's a strong home bias, which is especially strong for the pension funds and for the insurance corporations, right? So if we look at the second picture, we see this is for the pension funds and insurance corporations. We see that they hold mostly Eurozone issued securities, while the share of these assets for the mutual funds is much smaller, right? So the home bias is much more pronounced for one type of investors than for the other one. And finally, right, this is kind of following this recent issue about currency bias. We see that currency bias is actually even more pronounced, right? In a way, it kind of dominates this home bias. What matters is not where the issue is located, but in which currency the debt is denominated, right? So effectively, this, again, pension funds, insurance companies, they hold only euro-denominated debt, while the mutual funds hold both euro-denominated and dollar-denominated assets. Okay, so I would say this is kind of the main facts that we learn about the portfolios. Okay, so now, as you noticed probably already, there's the second part of the paper, which is kind of the key one, which is about the UIP, right? UIP and CIP deviations. So the first fact here is that these deviations from UIP and CIP, they are negative for the euro, right? So this is the picture for the UIP, which is computed using the expectations from surveys, right? And this is CIP, which doesn't require any survey data. And you can see that for most of this period, right, both measures are negative, right? So that effective returns on euro-denominated debt is lower than the returns on the dollar-denominated debt. So then, right, we can unpack that, and we can unpack it in two directions. So one is who holds these bonds, and second, what are these assets, right? So let's start with the assets, right? Let's look at the all corporate bonds and long maturity bonds, and you can see again the difference, right? We see that these negative yields, euro negative yields, are especially pronounced for bonds with a long maturity. Okay? And arguably, this has to do with the QE, right? The fact that over this period, the central bank, the European Central Bank, was intervening in these markets, buying long-term debt, and as a result, pushing down the returns, the yields on this debt. And finally, and I think that's kind of maybe one of the main results in the paper. I think Juliana has changed a little bit the emphasis in her presentation relative to the draft, but the way I read it is the paper kind of, but let's see whether we converge, right? Let's see. So one of the key results in the paper is that also these yields are very different across investors, right? So in particular, the euro debt held by these pension funds and corporate insurance corporations, it's actually lower than the yields held by the mutual funds, right? And again, you can see it from these pictures for the UIP and CIP. And my first comment, my effectively question is, how do we interpret this, right? So I think the intuition that the paper presents is something like this. Okay, so these pension funds, they don't like dollar bonds, they don't like risk. That's why they are holding only mostly euro bonds, right? So to kind of force them to buy any dollar bonds, these dollar bonds should have very high yields, right? And so kind of in equilibrium, we expect that the dollar bonds held by these pension funds to have much higher returns, and as a result, the euro differential is much lower, right? And so that's kind of formalized in the theoretical model, which argues that more risk-averse investors require higher risk premium, right? So this is the deviation from the UIP, and so it should be equal to the risk premium, and so the agents which have higher risk aversion should charge a higher risk premium, have a higher differential. So, but is this really right? So, I mean, at first I thought it's super intuitive, right? But on the other hand, if you think about, if you take literally their model where there are only two assets, one euro bond and one dollar bond, then clearly this thing is just the same for everyone, right? This is just the difference in returns, difference in two prices. So clearly it should be equalized across all agents in the economy, right? Yes, of course, there can be differences in the risk aversions, which will change the portfolios held by this agent, and the result will change, the risk that they hold, but it's not the price that differs across agents, right? So it's a bit of, I think, misleading intuition, or at least I couldn't really connect it to this formula. So instead, as I said, right, it seems like what we should expect to see is that the portfolio should be very different for different types of agents, and right, that's what we see in the data. So it seems to me that it would be more interesting to see, to kind of decompose these portfolios of these two types of agents, right? So if the average, so what is different in the data from the model, right? So this object, it's not just for one asset. It is some average across all assets using the weights, portfolio weights for different agents. And so the question is, what explains this difference at the aggregate level? So it would be interesting, I think, to decompose the portfolio into different weights and to show where exactly these differences in average UIP are coming from. Okay, so then the next result, which I think is also very interesting, is that, so they run the following regression. They look at the aggregate share of euro across investors, and they regress it on UIP, right, and also CIP. And so they find that this coefficient, this correlation is negative, right? So I wouldn't go that far to call it kind of a structural parameter, structural elasticity of demand, but it's interesting that it seems that over this period, what was happening is that UIP for euro bonds was going down, but at the same time, the share of euro debt held by investors was going up, right? Which is surprising because we would expect that QE does exactly the opposite. The central bank is buying this assets, and that's how it's pushing these returns down, right? So we expect the coefficient to be positive. And so this kind of suggests already that there was some positive demand shock. So simultaneously with the QE, also demand for these bonds was increasing, and they provide an interesting explanation to this, right? So that duration extraction channel, that more risky long bonds replaced the short-term risk bonds. So there was, again, it's for one asset it can't work, But if you have different assets and the composition of these assets changes, then maybe you can get this negative coefficient. I mean, I can come up with an alternative hypothesis, for example, that QE makes long-term bonds more safe, right? It's kind of a commitment that for some horizon, at some horizon, these prices of these long-term bonds will not change. That can also stimulate demand for these bonds. But in any way, I think it's interesting, again, to check this just separately, right? Run this regression for bonds with long maturity and short maturity. Okay, and finally, my last slide is about the model again. So Juliana didn't have time to talk about it more. I think we already discussed that maybe actually this paper is already have enough empirical results. Theoretical models is more just to understand what is going on. I think the key kind of three suggestions that I have. The first one is that the model is quite complicated, right? It has this Cochrane style model with habits. Why not to use the model which, at least to me, seems the most natural one, the segmented markets model by Gurinchis, Ray, and Vayanas, right? That was exactly the model that was developed to think about bonds with different maturities in two countries with exchange rates. It seems like just perfect laboratory to think about this effect. Okay, and so the second suggestion, I think we already discussed it, right? So the model right now has only two bonds, one euro bond, another dollar bond. It seems like to replicate this key stylized effects from the data, one needs to go beyond that. One needs to have short-term and long-term bonds. And finally, again, right, so this is the key friction in this model is the fact that arbitrageurs are risk-averse, so they charge a premium for taking risk. But of course, then you cannot explain the CIP deviations. Whether the model should do that or not, it's I don't know, not for me to decide. But I think if one wants to think about CIP deviations, then one needs some additional friction in the style of Cabet maturity. Thank you.
Hi everyone, my name is Andre, and today I'm going to present my paper called Corporate Taxation and International Financial Integration, US Evidence from a Consolidated Perspective, and that's a joint work with Agustin Benetrix. So the motivation for this paper is as follows. Multinational enterprises have an incentive to shift assets and profits to affiliates located in low-tax countries. Since the 1990s, there has been this significant increase in profit-shifting activities, and more recently, it is estimated that around 40% of multinational profits of multinational enterprises are booked in low-tax countries. Given this incentive that exists for firms to send assets abroad due to tax-related reasons, there's this question of how is corporate taxation related to international financial integration, and that's what we seek to tackle with this paper. Sure. Is it better now? Okay. So we focus on the Index of International Financial Integration of Lehner and Veghazy, and on the corporate income tax differential, defined as the difference between the US corporate income tax rate and the weighted average of the tax rate of multiple countries. The Index of International Financial Integration, or IFI, is given by the sum of a country's foreign assets and liabilities divided by GDP. So that gives us a sense of the relative size of a country's foreign balance sheet. Now, when constructing IFI, one could take the conventional residence-based approach, or one could take a nationality or consolidated by nationality approach. As I will argue shortly, the consolidated by nationality approach provides a more nuanced view around the activities of multinational enterprises, and because of that, it will make, I think that's the preferred measure in our study. So we have to construct that. So we construct an estimate of the US consolidated by nationality foreign balance sheet for the period between 1999 and 2019. And then we compute IFI on both approaches, on the nationality-based approach as well as on the residence-based approach. And here we find that the nationality-based IFI is on average 2 times larger than the residence-based one. So this means that the US foreign balance sheet is 2 times larger when we look at it from a consolidated by nationality approach rather than from a residence-based approach. Then we take that data and we run some very simple regressions studying the relationship of them with the corporate income tax differential. What we find is that IFI is positively correlated with the corporate income tax differential. And most importantly, the difference between the two measures, between the nationality-based, which is larger IFI, and the residence-based IFI, is also positively correlated with the corporate income tax differential. That is, the part of the US international financial exposure that is not captured by the residence-based approach, but is captured by the nationality-based approach, is also positively correlated with the corporate income tax differential. Now, why is that? We run a decomposition of this aggregate result, and we find that this result is mostly driven by multinational enterprises. Now, we take these three findings as indirect evidence that multinational enterprises are somehow taking advantage of differences in corporate taxation in ways that are not completely captured in residence-based statistics. Okay, now, what is the consolidated by nationality approach, and how is it different than the residence-based approach? So in conventional residence-based statistics, foreign assets and liabilities are booked according to the residence of the immediate counterparts in a transaction. Meanwhile, in consolidated by nationality statistics, foreign assets and liabilities are booked according to the nationality of the ultimate counterparts. And here's one simple example to illustrate that. So imagine that you have BNP Paribas, the French bank, lending $10 billion to a US bank, but that transaction takes place through BNP Paribas affiliate located in New York. So BNP Paribas in New York is extending this loan to this US bank. How would this transaction be recorded under both approaches? Well, under the consolidated by nationality approach, that's quite straightforward. It's a French bank lending $10 billion to a US bank. That's a French foreign asset and a US foreign liability. Meanwhile, in the residence-based approach, no exposure would be recorded. Why? Because it's a transaction taking place between two US resident entities, the US bank and this affiliate of BNP Paribas, which is a US resident entity. So no exposure would be recorded. And through this example, you can see that there is a part of local exposure, the exposure that multinational enterprises have in foreign countries that is not captured by the residence-based approach, but would be captured by the consolidated by nationality approach. Now, when should I use one? When should I use the other? Philip Lane gave a speech on this topic last year, in which he said that a consolidated framework should complement rather than replace the residence-based framework, as both approaches offer specific advantages depending on the purpose at hand. Here, as we are focusing on multinational enterprises, we take the nationality-based approach, given, again, that it provides a more nuanced view around the exposure of these multinational enterprises. Now, how do we construct the US consolidated by nationality foreign balance sheet? Luckily, there's a lot of good publicly available data for the US. So we use data from the BIS, the BEA, the Federal Reserve, and the US Treasury. And we follow a methodology that was pioneered by the BIS, which constructed the consolidated by nationality foreign balance sheet for one single year. We take that methodology and we extend that for this 20-year period. And this is one key data contribution of this paper. Now, let me pause here and say that this paper is part of the larger Consolidated Foreign Wealth of Nations project that seeks to construct estimates of foreign assets and liabilities from this consolidated by nationality approach for multiple countries. Here's US IFI on a nationality-based perspective and on a residence-based perspective. So the blue line shows US IFI computed on a consolidated by nationality approach, and the red line shows IFI computed on a residence-based approach. And you can see here that in every year in our sample, the blue line stands above the red line, which means that the US consolidated by nationality foreign balance sheet is larger than the residence-based one for every year in our sample. In fact, if you take the average of the difference between the two series, we get that the US nationality-based IFI is, on average, 2 times larger than the residence-based one. So it's quite a big difference. Here I'm showing this difference. So we're looking at the difference between the nationality-based IFI and the residence-based IFI. You can see that there is a positive time trend there, and that this series, at least the maximum, is achieved around 2014-15. And what I want you to focus here is on the magnitude. So here we're also talking about trillions of dollars. So you can see here that the peak goes above 200% of US GDP. So it's quite massive. Here's the US consolidated foreign balance sheet for one single year, which is the last one in our sample, and that's 2019, and that's shown in trillions of dollars. What I want you to focus is on two things. First, instead of having FDI as you would have on a conventional residence-based IIP or foreign balance sheet, FDI is replaced by the positions of US multinationals and of foreign multinationals. The second thing I want you to focus here is on the magnitude of US non-bank multinationals. So in 2019, we estimate that US consolidated by nationality foreign assets amounted to $55 trillion. And of that total, 28 trillion are associated with the activities of US non-bank multinationals. So these companies represent the single largest source of US international financial integration at the end of our sample. Here you can see the evolution of US consolidated by nationality foreign assets over time according to the categories that were shown in the previous slide. And I want you to focus here, so you can see that that grows over time. And I want you to focus on the gray area, which represents these US non-bank multinationals. So not only the gray area is the largest area here at the end of our sample, which is the fact that they are the single largest source of US international financial integration at the end of our sample, but also you can see that this growth in US consolidated foreign assets is mostly driven by the gray area, by these non-bank multinational enterprises during this 20-year period. Here we are showing the evolution of US consolidated by nationality foreign liabilities, and you can see that the increase in foreign liabilities is more widespread across categories. How relevant these multinational enterprises are in terms of the growth that we've seen during this 20-year period. So what we do is the following. We take US foreign assets, foreign liabilities, and IFI, and we decompose the overall growth that we've seen during this 20-year period according to each of the categories, such that if I sum across each of these columns, it will add up to 100. And here you can see that US non-bank multinationals, they have generated around, they are responsible for around half of the expansion in US IFI during this period. Now, if we go back to the motivation, this 20-year period in which IFI increased dramatically, and it was mostly driven, or at least half of it was driven by US non-bank multinationals, that's the same period in which profit-shifting activities really took off. So given these two things and the incentive that firms have to send assets to affiliates located in low-tax countries, we investigate whether these two things are related. So our empirical analysis is very, very simple. We focus on studying the relationship between the US corporate income tax differential and IFI, on the difference between the nationality-based measure of IFI and the residence-based measure of IFI, and then we zoom in the part related to multinational enterprises. We compute the corporate income tax differential as the difference between the US statutory corporate income tax rate and a weighted average of the rest of the world. And we use to weight that, we use the sum of bilateral FDI stock between the United States and a given country I. In our robustness checks, we use different weighting schemes, but the results won't change. We then detrend all the variables. So these variables, they all have a time trend, so we detrend them. And then we run these three sets of regressions. The first one is IFI on the corporate income tax differential and some controls. Second, the difference in IFI or DIFI on the corporate income tax differential and some controls. And the last one is where we zoom in on the part related to multinational enterprises on the corporate income tax differential and again some controls. Among our control variables in our baseline specification, we include trade openness and stock market capitalization as percentage of GDP, as these are variables that are usually correlated with IFI. Here we are looking at the regression results for IFI as our dependent variable, and we have IFI under both approaches. So columns 1 and 2 show the regression results when IFI is calculated on a nationality-based perspective, and columns 3 and 4 shows the regression results when IFI is computed on a residence-based perspective. You can see that the coefficient estimate associated with corp tax is positive and statistically significant across specifications. You can see that the coefficient estimate associated with corp tax is larger in the regressions in which IFI is computed from a nationality-based perspective. And also, it's statistically significant at the 1% level, whereas it's only at the 10% level from a residence-based perspective. Then we'll focus on the difference between the two measures of IFI, the larger nationality-based IFI and the residence and the residence smaller IFI. And we find a positive and statistically significant coefficient in these two specifications here. Now, what is this result telling me? This result is telling me that the difference between the two measures of IFI, which is the part of US international financial exposure that is not captured by the residence-based approach, is positively correlated with the corporate income tax differential. Now, this can be because of activities of multinational enterprises or something else. So we need to somehow try to check or test that. What we do is to decompose this difference in IFI into two parts. One part that will be the difference that is associated with the activities of multinational enterprises, DMNE, and the other part, which is the difference that is related to everything else but multinational enterprises. So we are decomposing the DIFI regressions that I've just shown you into these two parts, such that, for instance, if I take this third column here and I sum the coefficient estimates shown in this fifth column and in the seventh column, it should add up to the original regression. So I'm just decomposing this regression result. And what I want to highlight here is that out of the 4.0 coefficient estimate from the DIFI aggregate regression, 3.1 comes from the part related to multinational enterprises, and only 0.8 comes from the part unrelated to multinational enterprises. So here they don't add up just because of rounding, but they mathematically add up precisely. So this result is telling me that around 80% of this positive coefficient estimate comes from the part related to multinational enterprises. So this result is telling me that not only the difference in the two measures of IFI is positively correlated with the corporate income tax differential, but that appears to be mostly driven by multinationals, which once again is an indicative or some indirect evidence that US multinationals are taking advantage of these differences in corporate taxation in ways in which they are not completely captured by the residence-based approach. Okay, how big a deal this is? Of course, in this study, we don't have the data to claim causality in any way, but we do have a simple back-of-the-envelope calculation, which is the following. A 1% increase in the corporate income tax differential would be associated with, on a nationality-based approach, a $360 billion increase in US foreign assets related to MNEs. And on the residence-based approach, a $120 billion increase in US foreign assets related to MNEs. So there is around $240 billion that would not be captured by residence-based statistics. So to conclude, I find that IFI is positively correlated with the corporate income tax differential. That's true under both approaches. The difference is also positively correlated with the corporate income tax differential, indicating that the part not captured by the residence-based approach is also positively correlated with the corporate income tax differential. When we zoom in, we see that this result is mostly driven by MNEs, or the activities of multinational enterprises, which we interpret as indirect evidence that they take advantage of these differences in corporate taxation. Now, as I have 1 minute to finish, I just want to talk about the next steps of the project. So we are getting ready to launch the first version of the data set, which will have the nationality-based estimates of foreign assets and liabilities for a set of countries. Thank you very much.
Okay. So what I was saying is that I would like to thank the session organizers and Stefan in particular for inviting me to discuss this very interesting paper. I'll give you the usual disclaimer that the views are mine and not necessarily those of the BIS, and then I'll move on. I'm not going to spend too much time summarizing the paper. I know we're running short on time, and it was nicely presented. Just a very quick summary. So the main focus is on the relationship between international financial integration, in this particular case, US international financial integration, and measures of corporate tax differentials. The core of the empirical approach is related to carefully distinguishing between residence-based or quote-unquote traditional IFI measures and nationality-based or consolidated IFI measures. With the difference being that in the former, the data are organized according to the residence of economic agents, and in the latter, the data are organized according to their nationality. The paper used a methodology similar to the one that was used in the BIS, in Chapter 5 of the BIS annual report back in 2015. But I will have some issues with the methodology, despite the fact that so this goes back to the disclaimer that I gave you at the beginning. As we heard, it combines nicely and creatively publicly available data from the BIS, from the Fed Board, the US Treasury, and the BEA. The main findings is that there's a positive and statistically significant relationship between corporate tax differentials and all measures of international financial integration, starting with the residence-based measures, then finding an even stronger measure for the nationality, even stronger relationship with the nationality-based measures, and then also with the gap between the two measures. And then the authors also find that the relationships are mainly, though not exclusively, driven by multinational enterprises. And this is interpreted as indirect evidence that multinational enterprises are taking advantage of tax rate differentials across countries, and they're doing so in a way which is not fully captured by standard residence-based statistics. This is an important contribution to the so-called consolidated approach to international finance. Now, as you nicely mentioned, there's no there's been a big push, including from me and co-authors of mine and many other people, for the consolidated approach, but all of us have been very careful to mention that it's not that one is better than the other, and I'm citing a speech by Philip here, that it's not that one is better than the other. The push comes from the fact that the consolidated has been ignored for so long that it obviously deserves to get a lot more credit and a lot more weight. But that's not to dismiss the residence-based approach, and one should think of those as complementary or as complements rather than substitutes. And then each one of them is valuable on its own depending on what the type of question that's being answered. So again, this is not, the push towards the consolidated approach shouldn't come as dismissing the residence-based approach in any way. But again, that said, given how more and more interconnected, well, I shouldn't be putting that in a dynamic sense because there's been a bit of a decline in globalization lately, but given how closely interconnected the global economy has become, the consolidated approach has become more and more important, at least over the past few decades. And this paper, the way I think of this paper is that it contributes to this literature that tries to address this lack of a triple coincidence. And the reason it's an issue that there's a lack of a triple coincidence, there's been a lot of papers that have, and work that has assumed that there is this triple coincidence among the GDP area, the decision-making unit, and the currency area. And in that particular case, that paper contributes to the literature that tries to distinguish between the first two, right? Between the GDP area and the decision-making unit. The idea being that the decision-making unit tends to be more closely associated with the nationality of a given entity than with its residence. So this is just a small graph to illustrate, this is one of many that we could have picked, that illustrates the importance of focusing on the consolidated approach for certain questions. So this is a graph that gives international debt issuance for a dozen major emerging markets, and it distinguishes between issuance by residence, which here we're calling onshore issuance, and issuance by nationality, which is basically the sum of the two, the blue and the red. And as you can see in the case of, so for some countries it doesn't make that much of a difference. If you look at Chile, Malaysia, there's a bit of a gap. But then if you look at Brazil, the blue area is what you'd get just looking at a purely residence-based measure. So this is Brazilian issuers in Brazil. And the red is Brazilian issuance issuing outside of Brazil. So what you'd get with the residence-based measure is just the blue area. With the nationality-based measure, or with the quote-unquote consolidated measure, you get the sum of the two. So obviously you'll be missing a big chunk. Similarly for China, India, Russia as well. So again, this is just a quick illustration of what a big difference it could make switching from one approach to the other. Again, in a very different context, but nonetheless underlining, underscoring the importance of accounting for that difference. Now, on the data compilation methodology, one point that I would start with is that there's this measure of the gap between total assets and FDI, right? So in the case of when you're looking at, so you could do it on both sides of the balance sheets, but just to take the example of the asset side of the United States. Now, so that difference, of course, a large chunk of it could be, and in fact it is allocated to what you're trying to approximate, but it could also be, it need not be, right? Because part of US assets could be financed by either equity or bonds that are held by non-US nationals, right? In theory, you could have that. And then you could also have, in theory, loans that are extended by non-US banks, in which case, in none of these three cases, these would be US assets. And it also need not be part of multinational enterprises positions. Now, this is a nationality point. This is a sectoral point, right? So here, they could be financed by other sectors. Even though they could be financed by US nationals, they may not end up being financed by multinational enterprises, or may not be assets of multinational enterprises, which has important then implications for what you're finding in the econometric regressions. Then a couple of points on banks, which is, they're not as crucial, but still could, so this could more directly affect your main results. These two could affect them indirectly, but they're still important to keep in mind, is that you're taking the local liabilities vis-a-vis US residents, but these residents could be non-US nationals, right? So by definition, they are in the United States, but these could be like French nationals in the United States, or French banks in the United States. They could also be non-banks, right? So if you're taking the consolidated banking statistics, local liabilities, you don't have a sectoral breakdown. So that's another thing to keep in mind. Now, like I said, this is not, it's a bit of an indirect issue, but still something important to keep in mind. And then when you are doing the compilation for US banks, you're excluding the positions, excluding positions vis-a-vis related banks, which makes sense, but then also excluding central banks. So I would keep central banks, because these, so if you have like deposits of oil exporting central banks into US banks, these would still be liabilities of US entities vis-a-vis the rest of the world on a consolidated basis. On the methodology, my main comment is that it would be great if you could do a panel regression, right? Because right now you're collapsing all of that rich data that you have on cross-country tax rate differentials into a single variable by using these weighted averages, which is nicely and creatively done. But then in the process, you're killing a lot of useful information. So if you could do a panel, I know that, that's why I put this second sub-bullet here, that data availability might be an issue. But to the extent that you could, even if you had to make some additional assumptions, the trade-off might still be worth it to where there would be a cost of making the assumptions, but it might still give you something useful and interesting. On the timing, so right now in the benchmark specification, you're forcing them to be timed the same, right? So they both timed at t, but they need not be happening in the same time period. For example, assets could be moved or reallocated with a lag. Then the reallocation should depend, in fact, not could, but should depend on the persistence of the tax change, right? So you should be less likely to move assets or reallocate assets if something's expected to be temporary. And then my question is, how should we interpret the results on the so the results for the portion of the data that's not M&E? Other comments, these are obviously more minor since I put them on the last slide. It would be good to explain the intuition. So obviously the general direction of travel is clear, but it would be good if you give more intuition on the mechanics of how exactly that correlation should be happening, or what's driving it rather. On the policy implications, there was the global minimum tax agreement that was recently signed. So obviously what you're doing has implications for that, and that has implications for what you're finding. Financial deepening, you're measuring it with stock market capitalization. I would think that credit to GDP will be a more conventional variable to use. So you may just want to do a robustness check with that. Speaking of collapsing the tax differentials variables, like I said, it's a creative approach. I would be interested to see plots of the different measures, which would be a low-cost exercise. And if you could expand the sample, that'd be great, but obviously may not be possible at this stage. So in conclusion, it's a very interesting paper. It's a great contribution to the literature on the consolidated approach. I think with a few more adjustments on the data compilation methodology and on the econometric exercises, it could get even better. So I highly recommend it for everybody. Thank you.
Thank you to the organizers and Stephanie for having me present this paper. So the title is different from what's on the program. We're currently preparing a new draft. Our results, everything is the same, but we're making it a little broader based on the results we're getting. So this is joint work with Frank Warnock. It's on preferred habitats in the world safe asset, meaning the US Treasury bond. Now, as we all know, the US Treasuries are the world safe asset. They're used for FX reserves. It's the largest and most liquid bond market. It's a benchmark for loans, not only in the US, but also everywhere else. And importantly, it's the instrument through which the Fed conducts monetary policy. So the US Treasuries are the most important securities in the world, and investor behavior in that market matters. Why it matters? If investors, whether foreign or US investors, are inelastic, if they accept low returns, then the US government budget constraint is relaxed. It means that the US can run larger deficits and can issue more debt. Now, if specifically foreigners are inelastic, then also the international budget constraint is relaxed. So the US wouldn't care too much that its net foreign asset position is a negative 18 trillion because foreigners will be funding it if they're inelastic. But due to data issues, we don't actually know much about how investors behave in this market. So in some cases we think we do, but once we carefully look at the data, use the right data, we see that in the end we don't. So why we care about investor behavior? Because as I mentioned, investor behavior drives many of the things we as economists care about. How Fed policy is transmitted, about US fiscal policy space, and so forth. But in empirical work, investor behavior is inferred from performance. So usually in the literature, poor performance is calculated from not so accurate data, and then it's equated with inelastic demand. So this inference is made directly. So what we do here, we'll also infer investor demand from performance, but we'll do it with the most accurate data there is, and we'll do it carefully. So we start with the same, but we have good data to do that. So so we don't have a good understanding of investors' behavior, and there are two main assumptions that are currently, they're common in the literature, they're widely accepted and used. So these two assumptions in international finance are first, that there is a representative treasury bond, so we usually use the 10-year treasury, So the composition is such of the portfolio of all investors that there is one single treasury bond. And the second assumption is that we actually know something about the timing and magnitude of different investors' flows in treasuries and out of treasuries. The assumption is that foreigners have poor timing, they have low returns, and therefore they are assumed to be not price sensitive. So we show that with the data does not support both of these assumptions. Now, on the first assumption that there is a representative treasury bond, here I'm plotting the duration of treasury holdings per investor type. The red line, so the duration is in years. The top line are the US private investors, the red line. Middle blue line are foreign private investors. The bottom line are foreign official investors. So what we see is that there's, it's difficult to say that there is one bond, right? So we conclude from this that there is a preferred habitat. So US investors hold the longest duration portfolio. So on average, the duration is 7.3 years. And compared with, for foreign officials, the average is 4.3. So quite a sizable gap there. So treasuries are not viewed as a single bond. And importantly, because of this composition of the portfolio and this persistence of different durations, different preferences for different duration, this will naturally translate into different returns just because the duration of these bonds that they hold are different. So for example, if we take the 7-year treasury and the 3-year treasury, which is roughly the difference between the duration of the US private and foreign official investors, the difference is 120 basis points. So just because of this different composition, the returns would be different. Now, on the second assumption that we actually know something about the timing and magnitude of the flows in and out of the treasuries, what I'm plotting on the left chart is a commonly used data. So this is the TIC-S data. The dashed line are foreign private investors. The solid line are foreign officials. So what this data shows on the left chart is that for the entire sample period here, 2003-2019, foreign private investors have consistently purchased more treasuries than foreign officials. Now, and the gap, if we accumulate the gap, it's 3.5 trillion, quite substantial. Now, if we look on the right chart, this is a more accurate BEA data on flows that shows the exact opposite thing. So at least until 2015, foreigners bought more than foreign private investors. So from these two slides, we show that really the data does not support these two commonly used assumptions in the literature. Now, so what we do, so I showed you the results, but what we do is we'll use the best quality data. So we'll use security level data on holdings of treasuries for all investors, foreign investors, Fed, the total market, and then we'll calculate as a residual the US investor. And because our data are security level, it's comprehensive. When we aggregate that data, this would allow us to assess all these publicly available data sources out there that I showed you that there's a disagreement between different data sets on the flows. And then we'll look at the performance of the different investors. So we'll assess dollar-weighted returns. We'll look at the portfolios to understand average returns in order to make any conclusions about investor behavior. And we'll also examine more directly the question of elasticity. So we'll see how investors alter their portfolios and when they buy and sell treasuries based on spreads. Now, because I'm talking about the different investors in treasuries, here I'm showing you how big they are relatively. So US investors, as of 2019, US investors hold 40% of the market. the Federal Reserve held 20. So just as a reminder, this is 2019, so this doesn't include the latest round starting in 2020 of Fed purchases. And foreigners hold roughly 40%, with foreign governments holding about twice as much as foreign private. Now, what makes this study possible is the TIC data. So this is the US cross-border holdings data. It's confidential security level data. The sample period is 2003-2019. The data are comprehensive. It's the primary input to the US official statistics. So when you aggregate it, these are the, this sum to the BEA's published data. And importantly, the data includes security characteristics that allow us to calculate the returns for the different for the different investors in accurately. So so we have this data. So this is cross-border. So this is on foreign holdings of treasuries. Publicly available are the Fed's portfolio and the total market. So from these three, we construct as a residual the US investor. So this makes, so this is a difference between the US data and the ECB's data that Juliana presented earlier. We actually need to construct the domestic investor. It's not readily available. So this is the first ever comparison that is done that includes all participants in the market. Okay, so I'm skipping this. So what the data shows, so I'm plotting here holdings relative to outstanding amounts, left chart for, let's see if this works. Left chart for foreign. This is the share of foreign holdings in outstanding, the US and the Fed. And on the right chart, I decompose the foreign into foreign private, which is the bottom line, and foreign official. So what we see is that foreigners own much of the treasury market. So the in terms of shares of outstanding, it was high 58%. It's in 2008. It has declined substantially, but it's still 40%. And the decline in the foreign share is really driven by the foreign governments. And we see that this would matter for the interpretation of how elastic demand is, because we'll see that foreign governments are the inelastic, but their participation in the market has declined substantially. Now, in terms of flows, so here I'm plotting for the same investors, 3-year rolling sum of flows, and we see that, again, this is the solid line are total foreign, here decomposed in foreign official, the solid, and foreign private, the dashed. So foreigners were really the biggest buyers through 2015, and now they're surpassed by US investors. And really among the foreigners, government's purchases have fallen the most. So, so in the past few years, on the foreign side, it's really been the foreign private investors that have been purchasing this. Now, moving to calculating measures of performance, we start with the security level portfolios that would allow us to calculate average annual returns. Now, again, the sample period is 2004-2019. The top line shows you the average annual return per investor type for all investors, including the market, as a benchmark. And what we see is that the US has the highest return, and it's roughly 130 basis points higher than the foreign official, which is roughly the differential I showed you in the beginning between the 7-year treasury and the 3-year treasury. So what is leading to these higher returns for the US? It's really, as I showed you, the composition of portfolio. They have the highest duration portfolio. Now, we also calculate the Sharpe ratio. So these are average annual returns relative to the standard deviation. And we see that once we control for the volatility of these returns, the US really underperforms all other investors. Now, so this is a measure calculated based on the composition of portfolio. Now for returns, also the timing and the magnitude of the flows would matter. So this will so this on duration. So now we'll take into account the timing of those purchases and say what's actually happening with actual returns or the internal rate of return. So for this, we'll use a standard approach to compute the IRRs again for all different investors in the market. And so it's critical here that because of our rich data, we have all the components that are needed for an accurate calculation of the IRRs. So we're not making any assumptions. The data allows us to do that. So as an example of the advantage of the data I'll give you is that for the calculation of these IRRs, we have an initial investment, we have all the intermediate investment and cash flows, and the final payout. Now, because of our data that is security level, we can actually accurately calculate the coupon payments. Because we have the face values, we have the coupons per bond, and this is something that cannot be done with aggregate data or with any of the other data sources that are used. So what do the results show? So here's the table again for the period 2003-2019 per investor, including the market as a benchmark, the internal rate of return. Now what we see is that foreign investors with 2.52 are outperforming the US investors, and is the same for official and private. So we don't see any, so the data does not support that assumption that foreigners have poor timing when transacting in treasuries. Now we do some robustness checks and we use, so the table shows you the first column is what I just showed you. In the second column, we relax the assumption on, we don't do the calculation as accurately and say, okay, other researchers don't have our data on face values, so we'll apply the coupons to market values, so it's not very accurate, but we'll see whether that drives the results. And really the absolute numbers change, but the ordering doesn't. And in the last column, we'll use flows data, so aggregated flows data, we'll do the same thing. And we see that really the ordering doesn't change. So the result is that foreigners do, it's not true that foreigners have poor timing and low returns. They actually perform quite well. Okay. Now, the last question, so as I mentioned in the beginning, so the literature so far looks at poor returns, poor timing for foreigners, and says, okay, it means that foreigners are inelastic. But from what I showed you is that first part of the argument is not true. But then we'll go a step further and say, okay, we can actually analyze that. We'll see whether foreigners change their portfolios based on changes in spreads, and whether they increase, whether they change their purchases in treasuries based on spreads. So, what we find here, I'll show you the results. So in summary, what we find, so we first look at, we take the security level portfolios and we ask whether foreigners shift the composition based on changes in spread. So what we find is that private foreigners, but not foreign officials, increase the duration of treasury holdings when CIP deviations become more negative. So when their foreign sovereign synthetic yield relative to the US yield declines. And as a next step, we'll use higher frequency. So this is based on security level portfolios, but this is annual data. So the next thing we do is we use higher frequency flows data, and we'll actually ask, whether the flows themselves change based on changes in spreads. And the results are similar, that private foreigners do react to spreads, but not foreign officials. Okay? And the other result I didn't put here is that US private investors behave in a very similar way to foreign private investors. So there isn't really much of a distinction in the behavior of the two groups, and this is something that hasn't been really analyzed, and because we don't have all investors in the same database, we have not yet had that. So these are the results. I'm not going to show you. So, so just to put these in relationship to the literature, so what the literature has been telling us so far, more specifically the convenience yield literature, is that foreigners are willing to forego between 200 and 500 basis points for the convenience of holding treasuries. So this is quite substantial. There's a large literature on that. Some papers have calculated 500 basis points. Additional convenience yield. Some have calculated 200 basis points. And this is interpreted as foreigners having poor timing skill when they trade in treasuries, and therefore the conclusion that this demand, the foreign demand is inelastic. Now, another problem has been that the measures of performance have not been consistent because data are not available for all investors. Usually foreigners' IRRs are compared with market average returns. So this is not; these are not direct comparisons. So there's the challenge of data availability, the challenge of methodology. And so what we actually did is, because we have the database with all investors, we can calculate the same measure for all of them and compare them consistently. So what we found is that our results are very, very different from what the literature has been telling us. So in terms of IRRs, both private and officials outperform US investors, and really the differences in average returns among investors are driven by duration. They come from that preferred habitat that investors have. There's not a representative bond, but they invest, they have preference, persistent preferences for different duration bonds. And now, importantly, we find that private foreign investors do not have inelastic demand. They're price sensitive. We show this in terms of flows and in terms of changes in the composition of their portfolios. And foreign governments do appear to be inelastic, but their role in the treasury market has been declining. So these are governments that have accumulated large FX reserves, but since 2015 they have stopped increasing their reserves. So since 2015, on the foreign side, it really has been the foreign privates that have been purchasing treasuries, and they are the price-sensitive investors. Okay. Now, so what are the implications of that? Because we found that only governments have inelastic demand, and private investors have elastic demand, and because governments have been retreating from the treasury market, in terms of, as I mentioned before, the importance, why is investor behavior important? So we can't really be assuming that the US budget constraints whether, whether the governments or internationally will be relaxed by private investors, because both US private investors and foreign private investors are elastic. They are price sensitive. And the other implication is for the literature, so not only on the convenience yield, also on the exorbitant privilege literature. We don't find that much support for the literature that relies on the differentiation between foreign and private investors. And there are papers that use more general notions of convenience yield that doesn't rely on foreigners being different. And so the implication is that really there's more, there should be more weight on that type of analysis, rather than really relying on foreigners being different. And that's it. Thank you very much.
All right. Thank you very much for Stephanie and Alexandra for inviting me to discuss this very interesting paper. I just had to change the title last minute because I got an email over the weekend on the plane, but it didn't change my discussion too much. And I think it did highlight the narrative and the story. And I would say, though, discussing this paper was almost like a learning opportunity, running through hundreds of pages of instruction of the text, and I didn't know, there was so much instruction for people just to fill out these forms. But anyways, so I think this is a very important paper, and it made two main contributions. One is on data, and basically the authors determined the highest quality data possible to study the flows, and with emphasis on flows, into US treasuries by foreigners. And then armed with that data, then they study the characteristics, the performances, and also the behavior of foreigners' treasury portfolios, and maybe compare it to US investors. Oh, yeah. Oh, here it is. No wonder. I'm like, okay. This is a huge contribution to the literature on safe asset, where I must say theory kind of precedes data or good data. So my discussion would be basically three main comments on data empirics, and then kind of interpreting the results in the broader context of literature. Okay. So I just want to quickly summarize the data contribution here by kind of reviewing the different TIC data sources. So this paper relies the TIC SHL form, which basically all of the US resident custodians of asset for foreigners have to report to the treasuries. So the TIC SHL form is done once every 5 years, and that's the benchmark survey where all of the custodians have to do. And then every year, then they survey the largest custodians. So that's the SHLA form. So we have this form annually. A stands for annual. And this is very detailed at the security level. And type P, it means it's a positions data, so you report the total holdings. And then there are derived data from this source. So there's the BA international investment positions. So this is aggregated data derived from TIC, SHL, available at the quarterly frequency, also positions. And then the Fed flows of funds also derived from the same data source. So Alexandra basically find that the implied flows that she derives using this SHL data set correspond well with these two sources. And then there are two other forms that are on kind of flows-ish. So back in the day, there's the TIC Form S, which is soon to be discontinued. So this is also a survey to all of the US custodians where they have to report transactions. So flows data, but this has been around for a long time, but this data is not so good because you do not have a clean separation between net purchases and valuation effect. So that's what there's a newer form kind of starting in 2011, the TIC SLT data. That's almost like TIC Form S, but more improved is it was only positions data when it started, but now since this year, I think, it's going to be also including flows data and also valuation changes. And then there's what's referred to the BTBJ data out of 2 papers. Then they also leverage position data, but carefully derive flows from them using country-level indexes. Okay. So the empirical exercise here is, it's generally hard to go from position to flow. If you just look at the changes market value of a security, there will be 2 effects. You can do the decomposition. One will be due to net purchases, the fact that people are buying more of this asset, and the other one due to valuation. So the price of the asset has gone up, so the position goes up. And the authors are able to do to delineate these 2 things because they not only know the market value but also the face value at the security level. So in that formula, it means they know the P. Okay, so they can fully calculate net purchases and valuation, and this net purchase would be their implied flows. So armed with this security level flows data, the authors find a lot of facts on foreigners' portfolio of treasuries. Well, first, in terms of size, foreigners hold about 40 to 50% of outstanding treasuries. That's quite a lot. And then foreign officials are typically twice the holding of foreign private investors. And point 2 and 3 here are very important because it kind of stand in contrast with several findings from earlier papers, maybe using less accurate data, take S. But basically now the authors argue that the portfolio returns are very comparable across investor types. So, it's the narrative that somehow foreigners are taking ahead by buying treasuries all at the wrong time with very low yield, etc. So that isn't borne out in this new data set. And whenever there's return differentials, even though all of these differentials are statistically insignificant, whenever they are there, they seem to be driven by the differences in duration choices. And then they also find that private foreigners are not, do not have inelastic demand. So whenever there are changes in the CIP deviation, so for example, when CIP deviation is low, they find that private foreigners would like to sell treasuries and vice versa. All right. And then foreign officials, like central banks, would have inelastic demand. There are a lot more in the paper, but here I highlight the facts that I think are most important and would be very useful in terms of falsifying research going forward. Okay, so I will make 3 comments. So one, sorry to go back to this, but I think like the residency versus nationality issue is going to be big here. And I'm going to be a little bit more pessimistic about whether this can be solved or not. But here is just from the TIC major foreign holders table. So this is very aggregate data looking at foreign holders of treasury ranked by size. Most if not all of them are financial centers or tax havens. So UK is about 615, and actually if you go to the TIC FAQ, they would say discount about half of that. So there would be transactional bias, the fact that a lot of transactions are done in the UK, and also a lot of custodians are located in the UK, but the ultimate owner of these assets are somewhere else. So they actually give the UK as an example and say discard about half of that. So that's the UK, and then we know Luxembourg invests on behalf of a lot of Europeans, Cayman Islands. Maybe Cayman Islands would actually represent US investment. So there would be US equity investment into Cayman Islands hedge fund, and these hedge funds go back and buy treasuries. So I would say, though, that the authors have tried to take care of this a little bit in the exercise by, at point, exclude several of these. But if there's a more systematic way to do it, it would be great. Okay, so just to highlight the kind of residency versus nationality struggle. Now, this is the series illustrating flows of long-term treasury to foreigners. of BA versus the TIC-S data. So as you can see, the two series are actually very similar before 2011. And if you look up the BA FAQ, they say that we rely on the TIC-S to construct this series. And I mean, that's why they are very similar. And then after 2011, they switch to the SLT, which is a more informative form, and they start to have deviation. But even in periods when the BA coincide with the TIC-S, the decomposition is completely off, right? So the BA allocate a lot more to foreign official than foreign private. So I'm not sure if there's a methodology thing here of the BA that you could check and see. So all I'm saying is that the data is probably off, but it's not just noise. It's something systematic that's related to residency versus nationality. That said, I'm not very sure about how much the authors can do to fix this. So there have been several papers now, one by Antonio Coppola and co-authors in the QJE last year, and the other one by Berta, and I think you were one of the co-authors. But basically, what they do is they restate the destinations, okay, of portfolios of advanced countries. So let's say portfolio by the US or by EU countries. So I think going down flow is a little bit easier. You see, if you have a very clear portfolio detail, you see the bond, and then you see the bond issued by Petrobras held in Cayman Island, you can relocate that to Brazil. Okay, so I think that's a roughly, it's a hard exercise, but it's doable. But then to restate the investors might be difficult because you need to know the kind of ownership structure of Cayman Island hedge fund. But if there's ever data on that, I think that would be a great project. Okay, and then I want to push the authors a little bit more in terms of discussing their inconsistency with previous findings. And then this is not to say that I distrust the current paper's finding or the previous one, but I think, again, there are things about the data that we can learn here of what's causing this difference. So this is a chart taken from Krishnamurthy and Lustig, 2019, and basically they plot the correlation between net treasury flows and treasury basis. So what they define as treasury basis here is the negative of the CIP deviation in this paper. But basically they find the opposite. So in this paper, the authors find that foreigners would sell treasuries when CIP deviation is high. So we can think about a period when everyone rushed to buy the dollars, price up, yield is really low. And so these two people would find very different things. The paper here would find that foreigners would sell treasuries in those episodes, while in the kind of convenience yield literature, they would say that, oh, foreigners would love to absorb that net sell. So I think since you have such a great data set, and then you know exactly the valuation effect, I think you can actually shed light on what might have caused the wrong finding in the past. So a story could be that maybe there was really net sell instead of net purchases, but because of a high valuation effect, the fact that the price of treasury has gone up so much, so whatever that are still in portfolio is now worth a lot more. So that's why they have the different finding because of the valuation effect. But anyways, I think if you can push a little bit in that direction, that would be a great addition in the paper. Not only you highlight a problem, but like explain it, right? Okay. And my third comment is actually a minor comment, but whenever I see like a capital flows regression, then I start to get nervous around the global financial crisis. Because the result could be picked up, there was something about the financial crisis that's picking up all of these results. So as an illustration, there's a paper by Lilly and co-authors in 2019, and the paper is called Exchange Rate Reconnect. So they find that in general, exchange rate is disconnected from everything. But for some reason, around the global financial crisis and 5 years after that, exchange rate is positively correlated with US foreign bond purchase. But then that disappeared if you are 5 years away from the crisis. So something that would be worth doing for a robustness check is to rerun your regression, estimating elasticity, but doing either excluding the crisis or doing like a pre-post crisis analysis. And then some more minor comments. Why stop at investor types? I think with the SHL form, you also have geographical location, which is not perfect, but maybe that's something to learn. And then currently, the methodology would assume that there's no portfolio reallocation between the annual survey months, so from June to June. But this could be important. So suppose there's a crisis that happens in September, and there's a lot of reallocation and capital gains in those periods, that may not be captured if they revert back to the original position, right? So they have earned the capital gains, but they revert back to the original position. That's another comment. But overall, it was really hard to find comments against this paper. It was very well done. And I think this is very important, especially for the theoretical research going forward. Thank you.